Hi everyone. Today we'll discuss Ind AS 115 revenue recognition. Ind AS 115 is a five-stage process. Identify the contract with the customer, identify the performance obligation, determine the transaction price, allocate the transaction price to the performance obligation, recognize the revenue. Identify the contract with the customer. The contract can be oral, written, or implied, but the same should be enforceable. A contract will be enforceable if it has payment terms. The revenue can be recognized only if the customer has the ability to pay and intend to pay. If the customer does not have the ability or intent to pay, revenue would not be recognized. If the same has been recognized earlier, then the same would have to be reversed by virtue of bad debt. Identify performance obligation. The same should be distinct goods should be distinct goods or services, and the same should not be interdependent. The transaction price should be identifiable for the distinct goods and services. And IT software and installation. If the purchase of this IT software is done and the installation can be done by any person in the market at a cost, then IT software would be the one performance obligation and installation would be another performance obligation. If the installation is free of cost, it can be done online by following the steps. IT software and installation will be a single performance obligation. Determine the transaction price and allocation. The transaction price has to be determined by market forces. If the IT software is available in the market at 10 lakhs and the installation is 5 lakhs, the vendor is charging 14 lakhs for the software and 2 lakhs for the installation. Then the total proceeds 16 lakhs will be have to be allocated on the basis of the market price, that is 10 and 5, and not 14 and 2. Recognize the revenue on the basis of PO and transaction price. Contract uh, Contract modification. In contract modification, there are three scenarios. Distinct goods and services at market price. The same would be recognized as a separate contract and would be recognized separately. Good A, 100 units are given at 50 each, which is the market price. Good B, 200 units are given at 100 each, which is the market price. Since good A and B are distinct goods and services and the same are being sold at market price, the same would be recognized as a separate contract. Not distinct goods and services at market price. The deferred revenue would come into play, and the goods and services would be recognized proportionately. Good A uh, is 50 units at 100 at market price. Good A is 100 units, 120 at market price. Uh, Costs to be recognized proportionately. 50 into 100, 5,000. 100 into 120, 12,000. Total 17,000. 17,000 divided by 150 would be 113.33. Count this. Bank account debit 50 into 100, 5,000. Deferred revenue account debit 15 to 13.33, 666.5 to revenue 15 to 113.33, 5,666.5. In the For the second category, bank account debit 100 into 120, 12,000 to revenue 100 into 113.33, 11333 to deferred revenue 100 into 6.66, 666.5. Deferred revenue will get squared off in both the transactions. Not distinct goods and services and not at market price. The same would be cumulative catch-up approach. AMC in year 1 is 5 lakh and AMC in year 2 is 6 lakh. The company after 1 year decides that the AMC for both years is 9 lakh. In this case, there are no distinct goods and services and the same is not at market price. Hence, the revenue will be recognized as follows. Revenue in year 1 will be 5 lakh and 5 lakh. Since the same is recognized in year 1, in year 2 there would be additional 4 lakhs would have to be taken as revenue, as revenue, and the revenue has reduced additional 4 lakhs will be taken as revenue, and the cumulative catch-up approach will have to be followed. Incentives. So additional 4 lakhs will be taken as revenue. This is from 2 lakhs. Additional 4 lakhs will be taken as revenue in the year 2, and in the year 2 the total revenue would be 9 plus 4 lakhs, that is 13 lakhs. Incentives would be recognized as separate performance obligation. Sales returns. There is a sale of 3,000 and the cost is 2,000, and there is a probability of 10% sales return, and the sales returns happens and the scenario for sales return does not happen. Let's say for example bank account debit to revenue 3,000, cost account debit to inventory 2,000, 10% sales return revenue account debit 300 to sales return liability 300, asset account debit 200 to cost account 200. If sales returns happens, inventory account debit to asset account 200, and sales returns account debit 300 liability account debit to to uh, to uh, bank account 300. If the return does not happen, sales returns account